we bring in Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us every week. Dhirendra, welcome to Investor's Guide in a brand new year and thank you for joining us. Well, Wilson Satya is our lucky NRI. We take a look at his entire portfolio this week. He's 34 years old, Dhirendra. He has two daughters who are 3 years and 5 years old. He moved to the Middle East in October 2012. So he tells us all of the investments he sent us on this list were made when he was still an Indian resident and he hasn't really had the time to make those changes. He wants to know what changes he should make now. Now, his goals are to create a corpus of 1 crore rupees for both of his daughters and a 3 crore rupee home which he would like to buy in India in the next 3 years. He pays a premium of 30,000 rupees a year on his ULIPs and his money back plan. He wants to know if he should continue that plan. And before I go into his mutual fund investments, his big question is this. Now, on all of his investments, including his PPF, he's listed as a resident Indian. He wants to know if he should make those changes on these investments right now and if he should move the money from his resident Indian bank account to an NRI account. Would you recommend he gets that done as soon as possible, Dhirendra?
I think so, and there won't be a problem. His PPF account, it's not possible for non-resident Indians to open a PPF account. But if he possible that he's in his old PPF account, he can continue his contribution. So he should inform and make all those changes accordingly. And doing this in a transparent manner is very important. Otherwise, at some point in future, the tax fellows in India will ask him what is his source of income, or it'll amount to misrepresenting. That might just complicate his financial affairs, and he clearly has plans to come back.
But Dhirendra, let's take a look at his mutual funds that he sent us. Given the goals he has in mind, he has Access Equity, HDFC Tax Saver, HDFC Top 200, ICICI Prudential Discovery, Reliance Equity Opportunities and the Sundaram Select Mid Cap Fund. He also has the ICICI Prudential Focus Blue Chip Fund. Now, given what he wants to do with this money and the amount he's contributing every month, would you like him to just continue these SIPs?
I think he should continue these SIPs, and he has chosen good funds. It's a mixed bag. It is well diversified by style, by AMC. So I think he should continue that. If he wants a little more active management or somebody taking an oversight, he can well map his portfolio to our growth portfolio, which is quite a similar portfolio and fewer funds.
Well, then I have one very quick question for you. If he does have to discontinue his PPF account, and that's possibly his fixed income allocation in his portfolio, would you like him to open an NRE deposit, which is fundamentally a fixed deposit for NRIs?
Yeah, absolutely. And I think that should be ensuring an allocation, and for that he should first arrive at what his fixed income allocation should be.
Alright, so the advice that you've got from Dhirendra is on your screen right now. Go through each and every one of your investments and make sure that you can still make those investments as an NRI and move all of it to an NRI account because it's better for taxation, and continue those mutual funds unless you want to shift to our portfolio that's on your screen right now. Feel free to write back to us if you have any more questions for the show. Our next question comes in from Ruchi Bansal, who writes to us on behalf of her husband. She tells us he's a 47-year-old NRI who earns a monthly income of 5 lakh rupees. Now, he has property in Gurgaon, Noida and Mumbai, and he has a term cover of over 1 crore rupees. Now, he also has running home loans on these properties, but he's taken home loan insurance on all of them, so that's covered as well. He has an Indian fixed deposit, Dhirendra, of 15 lakh rupees and 18 lakh rupees in his NRE account. His goal is to create a retirement corpus, and after 5 years, he wants a portion of that money to be used for his son's higher education. He's hoping to send him overseas as well. Now, he's been recommended the ICICI Prudential Elite Wealth Plan. Now, this is a specific ULIP for HNIs, and he wants to know if it's worth investing 5 lakh rupees a year for the next 5 years in this plan to meet his goals, or would you recommend he uses mutual funds instead? What would you like him to do?
No, I would certainly, strongly urge him to keep away from that, simply because he has adequate term cover. He understands that, and he has also taken cover with an understanding that how much is his outstanding liability. From that standpoint, he doesn't require a ULIP. Then comes, how he should approach his investment. His first goal is quite close by, his son's education just 5 years away. So that should be put very conservatively. And so maybe, 1 or 2 years requirement can well be into fixed income. And, the remaining can have a very small allocation to equity. And his retirement, which might be, little far off, And for that, he can consider a balanced fund. He can well consider our, conservative portfolio, and that should take care of it. And he should certainly keep away from anything which combines insurance and investment.
And Dhirendra, again, that 15 lakh rupees in an Indian fixed deposit, is that the most efficient way for him to make money?
It depends. I would look at it as some kind of emergency fund, and given the scale of his liability, it may not be a bad thing to have it, have an Indian denominated, but to enhance his return, he should certainly consider an NRI deposit.
Alright, so if you have any more questions for Dhirendra, write to us. Our email ID is at the bottom of your screen. Now, before we go into break on this segment, we get so many questions from NRIs asking us when they have to file their taxes in India, at what point will they have to pay tax in India, and if the rules are different for them. So take a look at this quick report on how the tax department views NRIs.
So to begin with, it is important for you to understand your residential status, which totally depends on the number of days you spend in the country in a financial year. NRIs can stay up to 181 days in India each financial year. But if you stay for more than 181 days, you will be considered a resident and will be liable to pay tax under the Income Tax Act in India. So if you do qualify as an NRI, the money you earn overseas is not taxable in India. But you are liable to pay tax on income that arises from investments held in India. Whatever your residential status may be, it does not bar you from investing in India. However, there are certain restrictions.
Yeah, the 6 restrictions are the agricultural activities, which means he cannot buy a farmhouse or cannot buy agricultural land. He cannot, invest in a plantation activity other than tea plantation, for which there is a special exemption. He cannot invest in real estate trading. He can make real estate investment for the purpose of his own occupation or holding, but not for the purpose of buying and selling. He cannot do trading in the what is called TDR, the transferable development rights, which is again partly linked to the real estate only, and chit fund and nidhi, which are financial activities. So these are the 6 activities which are basically prohibited.
But you are allowed to invest in the equity market. You can buy shares, mutual funds and property. Any income or interest generated from these investments will attract tax.
As far as the property is concerned, whatever rental income they are having, on that there is a tax in India. When they sell the property, if it is sold after 3 years, it becomes a long-term capital gain, and there is a tax of 20%. They can claim exemption if they reinvest in another residential property, or if they invest in specified bonds up to rupees 50 lakhs. Also, they can repatriate the original amount invested up to maximum of 2 properties.
So if you plan to start an investment in India, you would be best advised to consult a good investment manager who will make sure your tax liabilities are looked after.